Welcome to our Vanguard Super Learn series. Today, we're going to explore ways to grow your superannuation. Whether you're just starting your super investing journey or looking to build your super knowledge, Vanguard Super is here to help. Your super is a long-term savings plan, and there are 3 key ways to help it grow over time. 1. Through regular superannuation guarantee contributions made by your employer. 2. Through any additional contributions you choose to make. And 3. Through investment returns with compound growth. Each of these provide an opportunity to boost your super balance and impact your standard of living during retirement. Let's explore each of these in more detail. So, what exactly is the superannuation guarantee rate? By law, your employer must contribute a minimum amount to your super fund. From 1 July 2025, that's at least 12% of your pre-tax salary. You generally qualify for SG contributions if you're 18 years old or over, or under 18 and working more than 30 hours a week. SG contributions are usually taxed within a super fund at a rate of 15%, which is lower than most income tax rates for Australians. Generally, all working members are eligible for SG contributions, whether you're working full-time, part-time, or casual. Contractors are usually eligible too. One exception applies to high-income earners. If you earn over $62,500 per quarter, your employer isn't required to pay SG contributions on any income over that amount. This helps you stay under the concessional contributions cap and avoid paying more tax than necessary. Any money that goes into your super account before tax is known as concessional contributions. These can include any contributions your employer makes on your behalf, and any additional money you might add in, known as salary sacrifice, which can be claimed as a tax deduction. These are taxed at 15%, which is lower than most income tax rates for Australians. The concessional contribution cap is $30,000 for the 2025-2026 financial year. This is the most concessional contributions you can make for the financial year without being subject to additional tax, and it covers all your super accounts. However, if your total super balance is less than $500,000, you can carry forward any unused portion of the concessional contribution cap up to 5 previous financial years. This means you may be able to contribute more than the cap without paying more tax. This can help you make contributions at a time that suits you best, such as when your work patterns and income change from year to year, including periods of maternity or paternity leave, or the sale of a large asset, like an investment property, which might result in a significant capital gain. You could use the carry forward rule to reduce taxable income in the year of sale, as well as boost your super. Remember, you can view your total super balance through the ATO. One smart way to grow your super is through salary sacrifice contributions. With salary sacrifice, you choose to give up part of your before-tax salary and pay it directly into your super account. This can help you grow your super more quickly and save on taxes. Salary sacrifice contributions lower your taxable income, which can help you avoid higher tax rates. Plus, you pay just 15% tax on these contributions, which is often less than the tax you pay on your income. Another way to grow your super is through personal after-tax contributions. These can be made at any time from your after-tax income and generally don't incur additional tax when paid into your super account. If you make personal after-tax contributions, you might be eligible to claim a tax deduction, reducing the effective tax rate to 15%. To help explain this a bit more, let's meet Sandra. In February 2025, Sandra decided to start a bookkeeping business from her home office and registered as a sole trader. Sandra decided not to make regular contributions to her Vanguard Super account because she figured that as a new business, her income may be a little up and down. Towards the end of June 2025, however, Sandra's business was doing well, and she decided to make a personal after-tax contribution of $5,000 to her Vanguard Super account and claim a tax deduction for it. Sandra will need to make the personal after-tax contribution of $5,000 from her bank account using BPay and let Vanguard Super know she intends to claim a tax deduction for the contribution by completing a Notice of Intent to Claim a Tax Deduction form available in Vanguard Online. Sandra must do both of the above things before completing her tax return before 30 June 2026. If you're a low to middle income earner, the government could chip in up to an extra $500 to boost your super through the Super Co-Contribution Scheme. You need to meet certain eligibility requirements, like making a personal after-tax contribution and lodging your tax return. The good news is that you don't need to apply for the co-contribution. If you're eligible and Vanguard Super has your tax file number, the co-contribution will hit your super account automatically. You can help your spouse grow their super by making contributions into their super account. Spouse contributions are especially popular because depending on your spouse's income, you may be able to claim a tax offset. This could reduce the tax you pay on your taxable income. The maximum tax offset you can claim is $540, where your spouse's income is less than $40,000. When the contribution is made to your spouse's super account, it is treated as a non-concessional contribution. In other words, like an after-tax contribution. Contribution splitting allows you to split employer SG contributions, salary sacrifice contributions, and any personal deductible contributions between your and your spouse's super accounts. This means you can both have super to draw on when you retire. It allows spouses who are not working or have a low income to build up super within their own fund. The First Home Super Saver scheme lets you make voluntary contributions to your super, which you can then withdraw to buy your first home. If you're eligible, you can apply to the ATO to release up to $15,000 of voluntary contributions, both before tax and after tax, per financial year, up to an overall total of $50,000. Just keep in mind, once you withdraw money to buy a house, you have 1 year to use it. You can find out more about the scheme on the ATO's website. If you're approaching retirement and your home feels too big, you can downsize and boost your super. If you've owned your home for at least 10 years and are over 55, you may be eligible to contribute up to $300,000 to your super from the proceeds of selling your home. If you own the home with your spouse, you can each contribute up to $300,000 to your super funds for a total of $600,000. So long as the combined amount doesn't exceed the total proceeds from the house sale. Contributions must be made to your super fund within 90 days of receiving the proceeds of sale. However, in some circumstances, you may be able to request an extension of time. Choosing the right super investment option is important. The contributions that are paid into your super account don't just sit there. They are invested in financial markets. The investments you choose for your super could shape the type of lifestyle you'll enjoy in retirement. The investments that may suit you best will depend on a range of factors specific to you, your needs, and your investment goals. With Vanguard Super, you can choose from a range of investment options, from a more hands-off approach to a do-it-yourself approach. Our flagship life cycle investment option automatically adjusts your asset mix according to your age, helping your savings grow while reducing investment risk as you approach retirement. Our diversified investment options offer a complete portfolio of investments, while single sector options allow you to invest in specific asset classes. You can mix and match these options to create your unique investment portfolio. Let's shift gears and talk about something that's just as important as growing your super: insurance. It's a way of protecting you and your family if life were to take an unexpected turn. Insurance through super can be cost-effective and convenient, but make sure it suits your needs. Premiums are typically lower than going directly through an insurance provider and are taken out of your super account, so nothing extra comes out of your take-home pay. There are 3 main types of insurance you can access through your super fund: death cover, total and permanent disablement cover, and income protection cover. Death cover is a lump sum to your beneficiaries if you pass away or are diagnosed with a terminal illness. Total and permanent disablement cover, or TPD, is a lump sum if you become permanently disabled and can't work again. Income protection cover provides monthly payments if you're temporarily unable to work due to illness or injury. At Vanguard Super, we've partnered with AIA Australia to include death and TPD in your default cover. Income protection is optional, and you can apply for it if and when you need it. Your default insurance cover adjusts as you age, typically decreasing as you get older. This is based on the assumption that your financial responsibilities may reduce over time. Just know that at any stage, you can adjust or cancel this default cover if it's not right or your situation changes. And finally, if you already have cover through another super fund, you can choose to transfer your cover to Vanguard Super or keep it where it is. Now, let's meet Alex. Alex is 38, works in IT and has a young family. After a cycling accident, he couldn't work for 6 months. Thankfully, he had income protection through his super, which covered 75% of his salary. This helped him pay the mortgage and support his family while he recovered. Typically, there's some eligibility criteria you will need to meet to be able to access insurance cover through your super. For Vanguard Super, these include being a member of Vanguard Super, aged 18 to 65 for TPD and income protection, or under 70 for death cover, being an Australian citizen or visa holder, not have previously claimed a terminal illness or TPD benefit, and not working in a hazardous occupation for TPD and income protection. It's important that before relying on your default cover, you ask yourself, do I work in a hazardous occupation? Have I worked at least 15 hours per week in the last 3 months? Or do I already have insurance through another super fund? If you answered yes to any of these, your eligibility or needs might be different. If you'd like to speak to someone about your specific insurance needs or what level of cover is right for you, we suggest you speak with a financial advisor. We hope this information has helped you understand how to grow your super. For more information, visit our Vanguard Super Learn Centre at vanguard.com.au/super/learn or contact us directly on 1300 655 101.